it's Dave Barnett from the investlocalbook.com blog site, author of Invest Local. There it is right there. Guide to getting superior returns in your own community without using the Wall Street or Bay Street banks to sell you a retail investment. I wanted to talk a little bit today about factoring. And it's a financial product or process that basically allows companies to turn accounts receivable into cash. So I wanted to explain, number one, the problem, and number two, this factoring solution. So if you are a business and you deal in a business-to-business environment where it's expected that you're going to give trade credit to your customers, that means that you ship them goods or you do a service for them, and then you send them an invoice, and then you wait 30 days or so, and then they mail you a check or transmit you an electronic payment or whatever. So you essentially, because of the industry norms, and this varies by industry, right? So if you're in the fast food business, you have no receivables. Customers walk up to the counter, they pay you, you hand them the food, no receivables. If you sell hard goods to retail stores, they're going to want you to give them trade credit. They're going to want, because ideally what they want to do is they want to receive your goods, sell the goods, turn it into money before they have to pay you, right? That way they don't have to have operating capital in their business because you're supplying the operating capital as well as the goods, okay? And extending trade credit and playing with trade credit is one of the ways that companies get their products on the shelves. So if I'm trying to enter a new market with a new product and the established competitor gives retail stores 30 days, to pay, one of the strategies I could employ is to come in and say, look, if you'll carry my goods as well, I'll give you 45 or 60 days, or I'll give you 45 days, and if you remove the other guy's product from the shelves, I'll give you 60 or 90, right? So you create a larger value proposition for the retailer to want to do business with you. So here's the problem. Every time I make a sale of $100, I need to have money to finance my costs. So let's say I pay my workers every 2 weeks and I've got to pay my suppliers of product. If I'm waiting for you to pay me, then I need to have money to pay my workers, right? So if I'm going to finance a customer $100, maybe I need to have $70 or $80 of my own capital to finance my costs until you pay me and I get to recover my costs plus obtain my profit. So a small business that is growing quickly and they're in this type of industry where they have to offer trade credit, they're going to run into a cash flow crunch if they're growing their sales, because it means every time I make a new sale to a new customer, I have to have the required operating capital to finance the receivable. Companies can grow themselves to death by making too many sales, and then they run out of capital because they're owed a bunch of money. And if they don't have either a credit facility, like a receivables line of credit from the bank, or they don't have the capital, all of a sudden they're at payday with a big stack of receivables and no money to make the payroll, right? So what factoring companies do is they help with this liquidity crisis, with this lack of cash. And basically they purchase the accounts receivable. And if I ship you $100 worth of goods, you now owe me $100. That debt, to me, is actually my asset. So what can I do with an asset? Well, I can sell an asset, just like I could sell, a car or a house or anything. So the factoring company makes a deal with me and they say, if you sell us this receivable, which forms part, it's created by a contract. So there's another contract called an assignment of the receivable, where I then, as the owner of this debt, this asset, give that to the factoring company, usually in exchange for an advance amount. So if it's a $100 debt, I give it to the factoring company today, the day the debt was created, and they give me an advance like $80. So now I've got my operating capital. My customer, though, no longer owes the money to me. They now owe the money to the factor. So when I send out my invoice, and I instruct my customer, don't pay me, pay the factoring company. Pay ABC Factoring Finance 123 Corp, whatever. The factoring company is going to have terms with me saying if it takes 30 days to pay, we're going to keep 3%, let's say. Say it's 0.1% a day. So 30 days later, the customer pays the factoring company, so they receive $100. They've already given me $80, and at that time, they're going to give me the other $17. So on the surface, it appears that I've basically gotten my money 30 days faster and paid a $3 fee, a 3% fee, which would put factoring kind of in the same ballpark as accepting credit cards. Because if I, instead of financing my customer and waiting 30 days to be paid, I said, listen, I'll take your Visa, MasterCard, American Express, I'm going to have to pay a discount charge to Visa, MasterCard, or American Express. It's probably going to be somewhere between 2 and 3%, right? And sometimes a little bit higher with some of these new points cards that are out there. However, because of tricks of time value of money formula, which is fully explained in my book, Invest Local, and if you want to learn why this is, you're going to have to read the book, and you're going to have to buy it, I guess. The actual returns on financing a factoring deal are not 3% a month, which would equate to 36% a year. They're more on the magnitude of 48% a year. And if you want to learn how that is, you're going to have to pick up a copy of Invest Local. Anyway, thanks. Always a pleasure to do videos while I block out the sun. Talk to you later, and come and visit me on investlocalbook.com. Always love to hear comments and love feedback, questions, etc. that I can answer in videos. Talk to you soon.